What's going on, guys? Hamilton here with the Trading Initiative, and in this week's Markets in Focus, wrapping up April 12th, 2024, let's talk about the roller coaster of a week last week. We're going to make this Markets in Focus video rather quickly because it is Sunday night. I'm getting prepared for pre-market or our Sunday night strategy session, for TTI, but I want to put this video out because last week was a doozy. If we look at how assets performed over the last week, Bitcoin down 6%. Now, was that directly in response to the Iranian attack on Israel? I have no idea. I'm not a geopolitical expert, and I don't pretend to be one. What I do know, though, is that a lot of geopolitical stuff happened over the weekend, and crypto sold off. Is it going to happen every single time? I have no idea. But I think the bigger question is the weakness in crypto going to leak into weakness in the market early this week, coming off of a huge drawdown on Friday? Potentially. Right now, futures are slide up. But that's something we're going to talk about in a little bit. So Bitcoin as of right now down 6.59% over the last week. Mid caps after hitting all-time highs down 2.92 on the week. Russell 2K down 2.82. I think this is a bigger chart than what most people are giving it credit for. We're going to look at that in a second. This is a big red flag for us in terms of wanting to add new exposure to the market as long as the Russell is not working. Oil down 1.57, the S&P 500 down 1.56. And once again, oil, which has been absolutely screaming, and energy stocks absolutely screaming, they were not spared from last week's drawdown. The Q's down 0.5%, although a lot of that was mega cap strength, which we're going to look at in a second. Copper slight up and yields up. Bonds had a terrible week in the market. Bonds hitting new lows over the last few sessions. Let's go ahead and dive into U.S. sectors really quick. None of this stuff should be particularly new if you've been following our content. Energy is up the most year to date. Com's still holding up well, but the rest of the sectors are starting to pull back slightly, particularly financials. After the JP Morgan earnings came out on Friday, the largest banking stock in the market got slapped, I think 7 to 8% to the downside on Friday, and it took most of the financial sector with it. Is that the beginning of something bigger? Is it not? I'm not here to speculate. All I do know, though, is if you were opening up newer positions expecting JP Morgan and some of these other banks to report to the upside, it just did not manifest itself whatsoever. Tech down over the last few sessions as well, but still up 6.9% on the year and is somewhat in a sideways consolidation fractal. A lot of that is semiconductors, though, right? I think we can all agree a lot of that is being propped up by semiconductors. But realistically, over the last 4 months here, year to date, energy and comms, that's been the place to be. Obviously, some value stuff in financials and industrials as well, but the rest of the sectors really aren't doing a whole lot. It's been a relatively challenging last 2 months. The first 2 months of this year were very easy. Essentially just be long everything that you were long. November and December of 2023, continue to hold those. But what we saw in February was a bunch of sector rotation, and that was alluding to potentially a market pullback. The market didn't actually pull back. That's all right. But that weakness that we saw come in February has persisted through April with a lot of these indexes grinding sideways, and we're seeing it on the sector level here. Energy up 8.79% over the last month. The rest of the sectors not really doing a whole lot over the last 30 days, right? Comms up 2.66. Real estate's down 6.2. Healthcare's down 4.74. Consumer staples down 2.18. So yeah, we saw sector rotation starting in January, February, particularly at February month, and it's continuing to persist into April, and it's translating into some really weak trends in a lot of different growth or risk on sectors of the market. Semiconductors, we were just talking about, up 26.2% on the year. They are masking a lot of the tech weakness in the market right now. They are holding kind of everything up. You can think of your NVIDIA, your AMD, your MU, your TSM. Some of them are reporting this week, actually. I think it's TSM. They are holding up right now, the tech sector, right? Apple has done very poorly this year. So it's obviously dragging tech down, but tech should probably be down even more. I mean, if semiconductors weren't propping this up, if NVIDIA wasn't propping this up, tech would be in the dumps right now on the year-to-date chart. XOP up 5.98%, AMLP up 11.54%. Once again, energy is leading on the year, and from an industry standpoint and from a sector standpoint, you have internet up 9.03%. So some select strength in the tech sector. You have gold miners up 8.87, but they did start to pull back slightly on Friday as well. You can see, though, the areas of the market that are performing the best right now are generally, other than semiconductors, generally not the fun types of trades that most people like to take, those high beta, quick, aggressive growth names. These are some slower duration style trades with lower ADRs, talking your energies and your stuff like that, right? If we go back over the last month, I'm sure it's not going to be a surprise. Gold miners up 12.05, XOP up 10.35, oil, metals, that's pretty much what we've been able to put on over the last few weeks here. And that's exactly what we have been focusing on in TTI, but it has not been easy. We're going to go through this in a second, but I want to kind of outline that the last 2 months of trading has not been particularly easy, especially if you've been adding new positions with lots of size, particularly buying the dip in some of the names that have stopped going up in the tech sector, consumer discretionary, and comm sector. It has just not been that type of market to where you can continually buy the dip and expect immediate response. As a matter of fact, a lot of people that have just indiscriminately kind of bought the dip, particularly in semiconductors, are now underwater on some really good plays because they never really looked at where it made sense to enter. They were just buying the dip, thinking this stuff has to continue to go up. You might be right in the long run. As a matter of fact, I think you are. I think semis are going to continue to outperform. But in the short term, if you're not respecting levels, not having the right type of time horizon, this stuff can really screw you in the short term and really make your life a living hell if you're consistently worried about your portfolio, because if these things are consolidating or potentially pulling back, those options plays are going to get crushed in the short term, which is why I want to bring up really quick. Let's go to our Twitter portion here, but perspective. We talk about this in TTI all the time. Last week on Friday, we had to close a bunch of trades that were just straight losses. We're going to go through a couple of those on TradingView in about 2 seconds. But perspective, we talked about this, and people were kind of talking about their year-to-date performances and stuff. And Dom graciously sent us over a screenshot from his account, said we can share it. So now, obviously, you guys are seeing it. But over the last year, he's been able to grow his account 225.56%. Year-to-date, he's up over 100%. Quarter-to-date or month-to-date, however you want to look at it, he's down 5%. It has not been an easy last 2 months of trading, and he's actually down on the quarter. But having said that, the bigger picture, if your account is continually hitting higher highs, if you are continuously buying the strongest stocks that you possibly can, as we're in the second year of a cyclical bull market, and you're not incessantly buying the dip on things that don't make sense, hopefully this drawdown is manageable. I'm not saying it's fun, I'm not saying it's comfortable, but it's manageable. Obviously, you're probably going to lose if you're long in a market that's falling. Even if you're hedged, you're probably going to lose some of what you've made over the last 6 months. Going long in November and waiting has been the winning ticket overall. That doesn't mean that it's going to be the winning ticket forever, depending on your time horizon, obviously, assuming that you're not a long-term investor looking to build a 401k and retire in 30 years. But realistically, if you're just randomly buying stuff, it's probably going to feel uncomfortable over the short term, especially if the market pulls back. So some perspective there from Dom showing you that it's okay to give some of that back. I think we had one other person inside of the group. One other person inside of the group post this as well. So obviously his account, even though we've bought some names that have been stopped out, are still up and to the right over time. And I think that's important. If you find yourself in the same boat there, where your account is up and to the right over time, it's okay to take some losses. It'll make this a hell of a lot easier as the market potentially pulls back. Let's talk about that actually right now. Let's talk about the market pulling back. Here's your Ethereum chart, by the way. Pretty nuts to think that this thing pulled all the way back about 30% from its peak. That is crypto for you. High beta stuff tends to do stuff like that. Let's start with SPY. Worst case scenario, what happens? We talked about this over the last 2 months. I don't know if this is worst case or best case scenario, to be completely honest with you, but let's pretend that this market does break. Let's pretend it does. We do expect at some point this year to have some sort of correction. A correction is, by definition, a 10% move. So a 10% move. Could we potentially see a 10% move from all-time high down, and what would that look like? Well, a 10% move, by definition, would be somewhere around 470. What would the market look and feel like if this pulled all the way back to 470? I can tell you right now that the market would feel like the end of the world was here. That it would not stop at 470 or somewhere near the 200-day moving average. Everybody would be screaming to short the market, buy as much puts as you can. We're coming back to retest 355 or maybe even lower. For those of us that don't give into the doom porn and stuff like that, we understand that generally speaking, in uptrends, markets do not go straight up. They have to pull back. Staircase to the upside is what we're looking to trade for a majority of swing traders, not just straight parabolic moves. It's awesome when we can catch them, but those things are not sustainable. Is this a realistic expectation that the market could pull back all the way to 470? Yeah, absolutely. And if it does, could it potentially hit new highs later in the year? Yeah, absolutely. This is what we expected to happen in February, and it never happened. I do think it could happen. Let's say it does happen. I know it's easy to speculate. Okay, great. You're telling us that the market could potentially pull back. And by the way, if this corrects, this is still a primary uptrend. We're still hitting a series of higher highs and higher lows. That's still a primary uptrend. So before everybody wants to take their full port and short a potential 7% move, 6% move in the indexes, understand that if we were to hit new highs, which probably we will by 550, there's a 20% trade that you could potentially take long, which is greater than the short that you could potentially make. So once again, please don't get lost in the sauce and short your entire portfolio in the market and then miss the easier trade, which arguably is just anywhere the market starts to find a floor and bounce. You do not want to miss potentially being long. It's the easier trade, guys. I'm telling you, it's going to be very choppy in the short term. I really doubt we're just going to get a straight capitulation move down. But once again, what happens in this type of scenario? Well, I'll tell you, in TTI, we're not the type of group to go and open up a bunch of shorts when we're in primary uptrends. If we can find short setups that we like, which if we come across them and it's convenient to make a video, I will make a video about it on this YouTube. But we like to short horizontal level breakdowns where price is below the 200-day moving average, and generally we have volume gaps in the VRVP. It generally gives us these capitulation zones where price it moves really fast underneath the support level, and these trades are generally aggressive and fast for what we generally trade, right? We're looking 45 to 180 days out. For shorts, we're closing within like a week or two, which is very quick for us. So if we identify some of this stuff, we will take it. But realistically, we like to do two things in markets that are pulling back, that are in cyclical bull markets. One, we like to just stay out of the market. I know that's boring. Some people don't want to admit that maybe you shouldn't be trading if your edge is not easily placed onto the market. I know that's not the sexy thing to say to sell subscriptions and stuff like that, but the easier trade is just to simply wait. And if you're waiting, you're not losing money. You don't need to catch every single move. This is probably not going to be a straight move to the downside. It's probably going to look something like this. And by the way, if you were short from late July through late October, this was not an easy trade. This thing bounced every other session into a dead cat bounce. You were always getting faked out. Your puts were getting fucking destroyed. It was not easy, but kudos to you if you made money. This occurred over a 3-month period last year, and I think we took 4 shorts over 3 months. We were just not as active. We were looking to get back in on the pivot, and finally, obviously, we did. We nailed it. We nailed almost the exact bottom, which was incredible. That's how you're seeing all of the success that we've had over the last 6 months, was because we were willing to buy this, whereas most people were trying to short the bottom, which just didn't work, obviously. So that's number one. Either stay out of the market entirely or go long inversely correlated assets. Go long, for example, the dollar, right? Through Dixie, you can use UUP. But if the market is going to crash, I think it's reasonable to expect, I shouldn't say crash, if the market is going to correct 10%, it's reasonable to expect that the dollar is going to outperform. And if that's the case, we would just like to park our cash in the dollar. Once again, using UUP, you can it's a relatively cheap trade. You can see that we did this exact same thing last year. And look at the date, August. We went long the dollar when the market corrected. This thing wasn't a huge winner. I think we ended up closing for in between 100 to 130%. I shouldn't say not a huge winner because that's a great trade. Don't get me wrong, but it wasn't like 1,000% winner like you see some of us trade inside of TTI. This thing moves very slow. It's a slow duration style play, but it's a lot easier in my mind to go long inversely correlated assets that are appreciating when the market drops, as opposed to going short the market. Buying puts and indexes and stuff like that is very, very volatile. It's a hard thing to do because every other day the market wants to bounce back up and it destroys puts, and then all of a sudden it hits new lows. And if you got shooken out, you're going to feel bad. And if you do that enough times, obviously a significant portion of the profit you've made being long over the last 6 months is now gone. So UUP is not the only asset that is inversely correlated to the market. I'm giving you guys a little bit of a hint here, though. If you can find assets that are inversely correlated and you can go long, it's relatively going to be an easier trade. Another one is probably XLE, the energy trade, the oil trade, anything like that. If you can find inversely correlated assets and there's liquidity on the chain, I encourage you to go and explore that. Having said that, if SPY is going to correct, that means the NASDAQ is going to correct. And what's a 10% pullback on NASDAQ? It's almost near the 200-day moving average as well, probably test the 400 area. I think these are absolutely realistic scenarios that could happen. And I don't think most people want to admit that are bulls that this could happen, but this is not inherently the end of the world. This is how uptrends work. This is what gives people the opportunity to have new setups in the market. Things aren't just going to go straight up all of the time, and I think it's important to have these conversations, to have built-in expectations. Obviously, if we gap up over the next 2 or 3 days and we're into new highs, then fine, trade that, obviously. Buy those new breakouts, etc. But have a plan for if the market starts to pull back, if we start breaking these bases, which SPY is already starting to break, the Qs are already starting to, or are testing it, and the Dow is already broke. This is our canary in the coal mine. We've been tweeting about it and talking about it a lot. The Dow is already broken down. The Dow is already broken down, right? And so obviously the largest component of the Dow are financials. Financials got thrashed on Friday, but healthcare is another big one as well, and healthcare got thrashed. The Dow now is breaking base. It's the first of the major indexes to break down. Now, support makes sense right here because previous resistance, but realistically, do you think it's going to stop there if the major indexes are going to pull back as well? Probably not. I think there's a date with 36,300, just like there's a date with the 200-day moving average in SPY and the Qs. Once again, if that happens, do not become complacent. I'm telling you, it's probably not going to end up in a new bear market. Just like the guys that thought there was a new bear market coming from July through October of last year, bull markets have consolidation phases. Bull markets have pullback phases, right? These corrective phases. That's what happens, and it always suckers in a new tranche of long-term put positions, and just don't get suckered into that. I think the worst looking chart of the major indexes right now is IWM back below 200. This is risk off territory for us. We have a lot of exposure in mid caps right now, but with the Russell 2000 back below the $200 area, or if we're trading back within the range that we've sat over the last 2 years, we don't want to continue to add into new positions within this market cap. It's clearly not working anymore, and so it doesn't make sense. Like Einstein, right? The definition of insanity is doing the same thing over and over and over and expecting a different outcome. Well, if we're below the $200 area that we were in for the last 2 years, there's no reason for us to continue to commit capital to this market cap. We don't want to do it anymore. So we already have mid caps on the books. We're going to trade those aggressively, moving our stops up in case all of them pull back, if the indexes do pull back. But I can tell you right now, inside of TTI, we're not taking anything in the smaller mid cap space as long as the Russell 2000 is below the $200 area. It's black and white. It's that easy. Having said that, some of the trades that we closed Friday, or just last week in general, I think we did a couple of them off here. So if I skip something, please forgive me. Let me go ahead and look through here really quick. Verizon was a stop out. This was a name that we bought. You can see it was a stage 2 breakout. We bought the actual break here, and we just got caught in a pullback. We got stopped out on Friday. We were dancing around our risk off level, so this was a total loss. I think I lost 56% of my total position. I did not let it go to zero. Obviously, I'm going to respect my stops, but this was something that just never ended up going, and so we got stopped out. Sphere was another one that I don't think I have on the list anymore, but we got stopped out of. This was a free trade for us, but it ended up being a stinker. So for everybody that was in shares, we got out for a minor profit. For anybody that was in options contracts, I got out for a very minor profit. But on Friday, this thing back below our risk on level after popping up about 15%. So we don't want it anymore, right? We got rid of it. We got rid of Sphere for a very, very minor win. We got rid of Verizon for a loss. I'm trying to think if there's anything else. There was a couple other ones that we actually got stopped out of. Not all of them were total losses, but I can't remember off the top of my head. And none of these look like they're on the list. So I'm going to go through trying to think really quick. I'm going through the names that we added into, at least myself. Last week on Friday, I added into the first semiconductor ad that I've had in the last 3 months. I have not added anything into the semiconductor space because I've been sitting here waiting for pullbacks at logical levels and discounts on the contracts. It was like a 3-tiered thing. I wanted discounted contracts, I wanted the right levels, and I wanted the right price. I mean, realistically, I didn't want to just buy the dip. I kind of led this entire Markets in Focus video with don't just buy the dip indiscriminately. Time it. Look at where you're trying to buy. AMD pulling back to the 160, 161 level is exactly where I've been sitting here planning to buy the AMD trade again. And so I did. I went and bought some January 2025s. I think that's important. Most of our semiconductor exposure is targeting Q3 right now of 2024. Most of them, if not all of them, are completely free. So we have AMD that's free. We have MU that's free. We have TSM that's free. We have ARM that's free. We have not added in as a community, but now we're starting to get in the mindset that, hey, if these things pull back into logical levels, let's start buying them. And so AMD, I bought the January 2025, so it's April 2024. I want lots of time on this stuff. And the cool thing about the AMD trade in particular is I bought the 230 calls for January 2025, and I got about I paid about 1/5 of what the guys were paying just a few weeks ago for the exact same contracts. So I got a huge discount. I paid around $1,000, $1,100 for these contracts each. And they were going for over $5,000 a pop just a few weeks ago. So that is a huge discount on a contract. Now, if AMD does not bounce at 160, I'm going to close the trade. But I felt like this was as good of area as any to start to test the water. I've waited for multiple weeks to do this. And therefore, I pulled the trigger on Friday into the big mass sell-off panic. I don't know if it's going to continue to go or not tomorrow. Maybe it does. If it does, I'll close and manage my loss appropriately. It should be a smaller loss. But if it doesn't, I just sniped a fantastic fill. I was looking to add into TSM as well. It is reporting this week, but the contracts were just too expensive considering its relative strength. We already have a position in TSM, so there's no reason to continue to add there if you don't want to, but we are looking. MU, obviously, I think is probably one of the strongest names in the domestic semiconductor space, and we want to add there as well above 126, but the contracts, once again, are holding up a lot. They're very, very expensive right now, and I think that's part of the reason why we want to remain patient. We don't want to rush this stuff because if we're just aping into these contracts and not giving the time to pull back or consolidate a little bit, then the price is going to remain high, and we're going to end up, if they do end up falling backwards, we're going to end up with a way bigger dollar amount loss than what we could have had if we were just simply a little bit more patient. Last thing I want to talk about really quick is our energy related plays. We have opened up a lot of energy related plays on Friday. This terrible looking candle, not going to lie, but if we go ahead and line chart it, doesn't really look that bad, right? Doesn't really look that bad. Come on. U.S. oil, though, was down on the week, and so U.S. Energy in general, not just U.S. energy, but energy names in general are going to be down on the week, and we like this. We like this breakout. We did an entire webinar deep diving the energy sector. I'll link it in the description below. I encourage you to watch it. It's about an hour long. We went through a bunch of different positions we're in, but we really, really like this play, and we think that there's a potential opportunity for energy to be breaking out into new all-time highs and running a secular breakout here. We have positions in MPC. We have positions in Valero. We have positions in XOM. We're trying to grab the market leaders in Valero and MPC. We have been able to grab the market leaders. XOM is the biggest energy-related company in the XLE sector, right? The entire S&P 500 sector, XOM is your biggest, and therefore, if it's at all-time highs, we want to own it. I think that makes a lot of sense here. So, guys, essentially what I'm saying is be careful for a potential pullback. It absolutely could happen. I outlined the levels, and if it does start to really break down, the levels that we're going to be looking at buying. We talked about it. Obviously, if you're sub to the channel, you're going to read, you're going to watch the videos that come out as it's unfolding. We're going to talk about, just like we talked about in October and November, if you look back at the channel, we're like, we're buying right here. We're buying right here. We're going to do the same thing. We're going to be patient. There's no need to buy the dip the entire time. We don't need to be the first assholes in the trade. As a matter of fact, I don't want to be. There's going to be plenty of people that are going to be trying to time the bottom. I'm not one of them. God bless their hearts. If they time it perfectly, I hope they make a movie about them and they make a bunch of money. It's not going to be me, though. I'm going to wait for the market to find some sort of floor if it does end up falling out. And I'm going to buy the right side of the V, concept that we talk about inside of TTI all the time. Buy the right side of the V, somewhere right here. Once it finds a floor and starts to bounce, I have no problem trying to get in on this side as opposed to trying to time the bottom anywhere over here. Not a winning combination for me. Guys, my name is Hamilton, here with the Trading Initiative. If you like this type of content, please like and subscribe. Leave a comment below. Tell me what you think. Is the market going to correct? If it is, where's it going? Is the market going to enter a new bear market? If it does, where is it going? What's your game plan? And let me know in the comments if you were short into Friday's open, made a bunch of money, and what the long-term idea here is. If you're going to remain short, God bless your heart. I hope you make $1 billion. I would like to hear about it. Let me know in the comments. I'll catch you next video.